So today we're going to be sharing our macro outlook of why stocks can be a good bet in 2023. They totally can rally. I know this is contrary to what a lot of people think, but hear me out. We've got the data to back up this narrative. So I'm over here, I'm at MAPsignals. I'm checking out our latest macro blog piece, and I want to show you something. A lot of people are worried about recessions, right? But here's the deal. Recessions are not the end of the world. And in fact, going back to 1926, here's the S&P 500 performance. 6 months prior to a recession, down 4.6%, right? Markets, they're going to be forward thinking, right? So that's why they're going to sell off. During a recession, the average return is a modest negative 1.2%. But get this. 6 months after a recession, stocks are up 16.9%. That is why you've got to stay long quality stocks, even if you're worried about a recession. But we can't stop there. Let's keep going. There's more than one reason to be bullish for 2023. So a lot of people are worried about inflation. Well, let's do some historical analysis on inflation. Stocks do well after inflation peaks, even in recessions. Holy moly. So check this out. So here's the current, right, since July. This is when inflation peaked in this cycle, and stocks are up 3.5%. But get this, the 12-month total return after inflation peaks, average 14.5%. Here's the average gain if it's followed by a recession, and then here's the average gain if not followed by a recession. So look, we may not go into a recession, we may go into a recession. Historically, stocks are up double digits either way 12 months out. All right, if that's not enough for you, let's get to the number 3 reason that stocks can do well in 23. People are worried about earnings falling off of a cliff. I get it, but let's do the historical analysis. So here's the deal. Stocks have advanced even when earnings contract. Believe it or not, people are worried about earnings going down. Well, that doesn't mean that the stock market is going to go down because the market is forward looking. So let's look at this study. This goes back to 1963, okay? So bottom quartile, earnings contract, S&P advances 7% over 12 months. Now, as you get to the next quartile, they advance 10.6%, 8%, and then 8.3%. So remember, earnings contraction does not mean that stocks are going to go down. In fact, historically, stocks actually go up. Now, let's get to the number 4 reason, valuations. A lot of people are worried about valuations. They're worried about paying up too much for stocks if they're going to potentially get cheaper in the future. So right now, the S&P forward PE is about 17.1. That's the 12-month forward PE. It's a slight premium to the historical average since 1990 of 16.3. But check this out. Equity valuations usually rise when earnings contract, and that's because the market is always forward thinking, right? The market isn't priced on the news that we know today. The market is priced on what is coming in the future. So check this out. Bottom quartile. So when earnings contract, valuations actually expand, all right, in a big way, 89%. And you can go through these different quartiles. Top quartile, it's only 4%. So when things are really, really good, stocks tend to not climb as much as they do whenever they are really, really bad. Makes sense, right? So how do you play this knowledge, right? This is really cool. And there's, a lot of reasons to be bullish on stocks. Well, let's go ahead and look at the sector ranks that we have as the market stands right now. You can see here, this is the MAPsignals, right? We take all of the stocks in each of these sectors and then we weight the MAP score. You got fundamentals, you got technicals, obviously energy, industrials, staples, materials, utilities. Those have been some of the bellwethers right now. So in Alec Young's post, he's our chief macro strategist. Let's see what sector he wants to overweight and is most bullish on for 2023. He's actually going to be going with financials, and here is why. Because when financials are cheap, they tend to outperform right now. So right now, financials, they have a low valuation of only 10.5 times the 12-month forward earnings. You couple that with a very healthy dividend of 2.7% and a 4% buyback yield. He really likes the upside here. So let's check in on this chart, and it's easy to see financials have outperformed when they're cheap, right? So we're looking from 1963 to now, the average next 12-month financials relative performance via quartile. So when they're cheap, like now, 5% is the outperformance, 1% as we go into a next quartile, and then they start to really underperform whenever they get expensive. So because they're cheap, he really likes this play. And he's got a nice ETF that he likes for it, and that is XLF. Let's look at that right now. Which, by the way, if you like this type of content, make sure to like and subscribe to our YouTube channel. It really helps us out. So right now I'm in the MAPsignals portal. I just pulled up XLF, right? This is the financial sector ETF. And then we're looking at the constituents right now. It's got Berkshire B, right? People love Warren Buffett. That's 14.5% of this fund. Then you got JP Morgan, that's 10% of the fund. You got Bank of America, that is 6% of the fund. So some big bellwether names in this ETF. Let's look at a chart. I'm over here in our portal looking at the big money flows. You guys know we are all about the big money. This ETF XLF, it had a lot of sell signals that came in earlier this year, but now we're starting to see signs of life. The latest data is showing that there is some big money support in this ETF. Tying that all together with low valuations, this looks like a pretty decent bet. Based on history. Hopefully you enjoyed this macro data-driven outlook. We hope to make you guys smarter. Remember, none of this is personalized advice of any kind. If anything, we just want to make you guys better investor. Always think long-term, and remember, don't get scared out of great stocks. We will see you next time.